What's up, everybody, and welcome back to MF1 Dividend Investing, Episode 5. In today's episode, we're going to continue with the tangent that is GameStop. If anybody watched the Episode 4 video, you'll know that I own some GameStop. I've owned it since 2018, and I said I would do a short video on why I decided to purchase it and hold it through the last few years before this crazy kind of boom from the short squeeze. And just for knowledge, I also continue to still own the stock, even though it did go through this massive run up the last month. So with that said, I just want to put the disclaimer out there. This isn't a recommendation to buy or sell any stock. This is just my opinions and for entertainment purposes only. All right, let's jump into it. First things first, in case anybody doesn't know, GameStop is a specialty consumer retailer. They sell video games, consoles, hardwares, toys, collectibles, electronics, other miscellaneous items. They have roughly 5,000 stores throughout the U.S. and internationally, and they are solely focused now on the gaming industry. Beforehand, they had some other businesses. Actually, I think when I purchased it, they still owned a kind of a telephone AT&T resale business, as well as Simply Mac stores, but those businesses have been sold off to focus more on gaming. Looking into why I would purchase stock, I just want to pull up the chart here from 2002 to today, which is the whole public history of GameStop. And big picture wise, so how did GameStop come on my radar? They actually came on my radar because of dividend investing. They were a dividend paying company up until a few years ago. And just big picture, when I looked at it, I figured or saw, in my opinion, that they were undervalued. They were having some trouble. They could, in my opinion, turn it around, and I would, buy now, wait for them to do the turnaround and get paid to wait by way of the dividend. Obviously, that didn't work out 100% because shortly after I bought, they ended up cutting the dividend. But at the time, it was probably the right thing to do, especially in light of the pandemic that happened. So that's just big picture how they came on my radar. Another big picture thing before we go into kind of the fundamentals or what I looked at in making my decision to purchase is you can kind of see it here in the chart. GameStop is very dependent upon the console cycle for video games. So whenever a new console comes out or a few new consoles come out, they have a boom in their share price, which then teeters off after a year or so as people wait to kind of for the next big hardware upgrade, right? And you can see that here in their stock price. You see these two big bumps since 2002. And they kind of correlate, if I'm not mistaken, with the release, right? This is 2007, 2006. That would have been the PS3 and Xbox equivalent would have been released sometime in 2006. And you can see a big boom afterwards in 2007 and 2008 from that console release, teetered off, and then kind of stays at a flat $20 a share until the next console cycle, which was in I think 2013. So you can see here 2013, right? It ramps back up. This would have been the release of the Nintendo Wii, PS4, and Xbox. And you can see it gets up around $50 a share again, hovers at there for a few years, and then teeters off. So big picture, me looking at that and seeing that kind of play out, knowing that a new console cycle was coming up, not knowing the exact date in 2018, I assumed either 2019 or 2020 it was coming out. When we get into the financials, which we'll look at in a minute, I said, hey, they're undervalued now. I'll purchase. I'll wait until the console cycle. I'll get paid to wait with the dividend, and then the stock price will ramp up, and I'll either continue to hold it as they pay out the dividend, or maybe sell for some profit. So that was kind of my big picture thinking. But if you want to get a little more into it, you can see there is an issue here, right? From this console cycle to today, the stock price didn't kind of flatten out. It just kept going down and down and down. And mostly that was due to just the nature of where we're at today, where everything is shifting to digital, right? People were saying, oh, I don't even know if the new PlayStation and Xbox are going to have discs, and then if everyone's just downloading, who's going to need to go to GameStop? Also, just retail in general has been, foot traffic has been down. Everyone's buying things online instead. So there's a lot of negative pressure on them to begin with. So what made me take a chance on them back in early 2018? I believe I picked up the stock for a little over $10 a share at the time. Okay, well, for that, we have to look at the financials. So before I purchase something, especially something I think is undervalued, and it has a downward trend in stock price, is to kind of look at their financial statements and just see if they really are in trouble. Do they have the wherewithal to make it through, and and that kind of, or and if the sentiment on the company is just wrong, in my opinion. Are people missing something? Sometimes you can look at the numbers and see it, right? People are looking big picture. GameStop going out of business. The famous line is they're the next Blockbuster, right? They have an antiquated business model, and they're just gonna die off as things turn to digital. So let's say that does the story of their financial statement ring true to that? And to me, it didn't, right? So if we look at revenues here over the course of 10 years, aside from what happened during the pandemic, they're pretty consistent. $9.5 billion, $9 billion. Here you can see in 17, right? They went down to 8 billion, but then perked back up to 8.5 in 2018. So pretty consistent revenue. And the other important thing with looking at the revenue, right? You got a company that has $9 billion, or even $7, $8 billion in revenue. And at the time, I think in 2017, 2018, their market cap was only $2.5 billion. So significant amount of revenue for their market capitalization. So for me, I see this as pretty steady revenue. Nothing falling off a cliff. Stock price shouldn't be going from 50 to $10 based on just looking at revenue, right? Top of the line kind of item here. Second, right, profitable company. In fact, even growing earnings per share. 2011, 2012, you see it was $2.85 a share. 13 was 185, then 362, 388, 356. Doing pretty good. Even 2018, right, 40 cents. 2019, 77 cents. It wasn't until this year that the earnings per share was actually negative. So it's a company that's earning money, not bankrupt, and it, to me, just had too much negative press driving the stock price down. And then also we obviously, as discussed in the last video, the short interest, but I'll get into that in a second. So in thinking, trying to bring me back to when I purchased this in early 2018, I looked at that and the history of the revenue, and I said, okay, console cycle coming up, revenues haven't dipped that much, positive earnings per share. They seem to be doing okay. They have their troubles, but they seem to be doing okay. The bigger thing for me, which really said, okay, I'm going to take the risk here and buy a little bit of GameStop, is the cash, right? Cash on hand. For a company that people are saying is dying, their cash on hand it was significant. I mean, you had 600 and almost $670 million in cash, which was increasing, right, from the years prior, or at the very least remaining steady. And if you go through, right, and look at the assets, total assets of almost 5 billion, and total liabilities of somewhere around 2 billion, right? Yeah, total liabilities, right, too. Almost 3, right? So 2 billion in equity. Not too bad. Not a company that looks like it's dying. And I don't know if I could pull it up here. Here's a long-term debt, right? So here's your long-term debt in 2017, $800 million. But you have almost 700 million in cash. So you almost your cash to debt is almost equal, and it's not a company that's going bankrupt, and anytime soon. And those numbers actually went up the next year and the year after with the sale of some of their non-core businesses, as I was discussing before, the I think it was Spring Mobile business, which was AT&T resale stores and Simply Mac. So you can see here, cash and cash equivalents went up 800, and then over $1 billion. And their debt was at that time, and this is 2019, was 472 million. So they could more than cover their debt, and kind of wait it out until the new console cycle came. So that was kind of my reasoning for purchasing. But the thing that kind of put it over the edge and really said, okay, I'm gonna buy this now, is the price to book ratio. So I bought this, like I said, in early 2018. And if you look here, right, price to book, and price to book is just the I think it explains it here, right? Market cap over book value. The book value of the company. You got to be careful because there's book value and there's tangible book value. So book value is going to include intangible assets such as goodwill, where tangible book value is hard assets. But this is just tangible. This is just book value, so it includes the intangibles. And you can see, it was trading at a ratio of market cap over book value of always over 1, right? And then here in 2018, right, it dips and it's now below 1. And just a very basic understanding of that would be, if the company were to be liquidated on February 3rd, 2018, its assets would be worth $2.3 billion. But you could buy the whole company right now for 1.7. So in my mind, you're buying a company that has more assets or is worth more than what you're paying for it at the time, if you broke it down to a per share price. So for every $10 that I'm buying of GameStop, right, I'm getting $11 or $12 in assets. So I said, okay, I'm willing to take this gamble. Now, book value, like I said, has a lot of intangibles. And as you'll see, I'll pull it up on the screen. Those numbers can be changed very quickly with accounting. So it isn't always a surefire way. Just don't go look and find a price to book ratio and say, oh, this company is trading at 0.4. So it's when it comes back to normal and normalizes, we're good, because there could be very good reasons for it to be trading under 1. In a price to book ratio. But for GameStop, I thought that it was wrong, or there was a reason for it to come back and be over a price to book of 1. So I thought I was getting a deal at the time. Now, of course, I was a little early to the game, and the share price continued to deteriorate significantly after I purchased this. And if I just go back, let's put this to 5-year. Unfortunately, the big run up and jump in the last month is kind of skewing this chart. But I purchased early 2018 for a little over $10. Somewhere around here, probably like $13 a share. And then it just continued to dip down, right? Lower and lower and lower and lower into like $3 or $2, I think it got to in early 2020. So why didn't I sell? Why did I hold on and not just cut my losses? From 13 to $2 or $3 as a significant decrease. One, again, I believed that the sentiment was wrong with the company. I felt like the console cycle was gonna pull them out. Two, I felt like they had a balance sheet that was strong enough that they would be able to go forward. Obviously, I didn't account for the pandemic, but even so, with the pandemic, they've been able to kind of shore up their balance sheet and make it through. And three, even though I was a little early to the party, I had some people that were a lot more important than me, making some bets on them as well. And I'll just pull that up. And this is all public information, public filings and things. So the first things was some of the, I would say, kind of original investors in the company. Not necessarily original, but you had Permit Capital and Hestia, right? They were kind of big investors early on. they released, this is actually came out, when does it have a date on it? Relatively, yeah, May of 2020. So this is even newer. But they were rumbling for a while, sending letters and stuff. But this is a really good just summary of where uh, all the problems were in GameStop and what they were trying to do to turn it around. So they were early investors, right? You can say here they own GameStop since 2011, 2012, and they were upset, obviously, because the share price was just deteriorating. And they put together this whole summary of what's wrong with the company, where it needs to be fixed, how to kind of get away from the underperformance that's been happening. And they really believed, right, the pieces are there to do it. You just need to focus and change things around a bit. But even before they released this permit in Hestia, before they released this presentation, right? The other guy that is much more important than me and smarter than me is Michael Burry, Scion Capital. The guy from The Big Short. He was wrote, he has to file anytime that he is Schedule 13, right? When he buys a certain percentage of the company. So he files this, and when he filed this, right, he had these letters he was sending to the board, and the letters kind of sum up why I would continue to hold this, and he kind of echoes what I kind of went through with the balance sheet. So you can see here, July 2019, right? He writes to the board, and he says, I have concerns with the management here. You're not allocating capital correctly, right? You tried to buy these cellular stores, which I talked about. You reversed and you sold it. That's good, but you shouldn't waste the resources that are coming from that sale. And he kind of saw what I saw with it, right? This was an extremely undervalued company, trading for less than book value. You get this huge, big pot of money coming in from the sale of one of the assets. At the time he wrote this, he's saying here, right, given the recent prices are under $5 a share, you should take, you have a $300 million plan that's already authorized to buy back stock. You should use whatever's remaining there, 237 million, and repurchase shares. If you did that, you'd automatically, just by the repurchase of shares, retire 2/3 of the shares outstanding, which would triple the earnings per share in the company, right? Because obviously the less shares are out, the profit in the company gets divided over a lesser amount, so you have a greater increase per share. So it's an accounting thing, right? The company's still making the same amount of money, but there's just don't have to divvy it out as much. And as an individual shareholder, right, your piece of the pie just got bigger if a bunch of shares are gone. So, he's saying this here, right? There's the stock price is so suppressed, and you have so much money just sitting, from the sale of this asset. If you just, fulfill your original plan to buy $300 million worth of stock, you're going to triple your earnings per share. And obviously, if the earnings per share triple, right, the stock price is going to go way up. So that was part of the reason I was holding it. The second had to do with the short interest. So he can see here, right? He also mentions that, right? Bloomberg reports short interest of 66 million shares, which at the time was 74% of the outstanding shares. So, this was crazy short interest, right? Highest in the United States by far. No other company was close. And forget whether short selling is good or bad. With short selling, with shorting the stock so much, it creates a high volume, and that's kind of what he goes in here. He's saying, hey, right, you have all these guys that are short or shorting the stock, putting extra shares into the market, right? So the liquidity is very high, right? The volume is very high on this stock, even though the market cap isn't that big. So with a high volume, you can kind of buy a lot of shares without people noticing, because there's a lot of shares changing hands every day. So basically what he's proposing is that, you can undertake, rebuying $200 million worth of your stock, and no one's going to really notice because there's such a high, volume based, or due to the short selling. So he's saying, hey, if you buy back all this stock, you're going to, one, look like a hero, and two, you can do it without raising the price too much till it's announced because of the high volume due to the short interest. So he's saying, hey, what is clear is you deemed $6 a share a good price to buy it back 2 months ago. Today, you can buy it for essentially half that. So go and buy it back. And I think he says if you bought everything back, you'd have a market cap, or sorry, not a market cap, a shares outstanding of somewhere around 30 million shares. If you know, today they have about 69 million shares outstanding. So they didn't do it completely, but they did buy some of it. But this was the hope, right? Back in 2019, 2019, you could see, right? The hope was use some of this money right here, right? 237 million, buy back the stock. Your cash is $500 million, executing the buyback in full, with the elimination of the dividend, you're good. You're good to go. And you're going to, make this thing pop like crazy. Up to $300 a share. No one, I don't think anybody was expecting that, but, there was definitely a pent up demand here. And you can see he just goes on and on about it repeatedly. And, he says it again here, right? As we enter 2020, if we drastically reduce our share count, it'll kind of affect shareholders, right? Or have the greatest impact per share basis. And, just one example, right? So he says if a turnaround is successful and if GameStop were able to shrink its shares outstanding to 30 million, which would have been purchasing, the $237 million worth of shares, right? You would be able to resume the dividend of $157 million. And now all of a sudden you're paying around $5.25 per share in dividends. So here you have a stock that's trading right now, or at that time, right, somewhere around $4, $3 a share. You have Michael Burry writing letters to the board saying, hey, if you simply use the cash you have on hand, not even all of it, just half of it, and buy back shares, so you get down to about a 30 million share count, and things kind of turn around, the console cycle's right around the corner, you can resume your dividend. By eliminating all those shares in the past, you could pay the same dividend you paid before, but now it would be worth $5.25 a share. So if I'm buying stock, and I wish I bought more at the time, but hindsight's 2020. I could pay $3 for the share, hold it for 2 years, and then start getting paid a dividend over 100% of what my cost is. My yield on cost was $3. Now I'm getting paid $5.25 a year in dividends. So I saw this as a potential to really, if some of this was implemented, and of course nothing's ever implemented 100%, but if some of this was implemented in even a minor form, the chances of GameStop jumping in price and doing well, were pretty good in my opinion. So that's kind of the reason I held, and that's also the reason why I'm holding still, because I feel like the negativity about GameStop and the pessimism that it's going to just go bankrupt is unfounded, and that they will continue to be a decent company, and if they can turn around, especially now with Ryan Cohen from Chewy, if he gets in. And really can shake it up and move some things around, plus the console cycle to give them kind of tailwinds to go forward. This could be a very viable company going into the future. And that's kind of my thesis, and that's why I'm holding, and I continue to hold. As far as where the price is going to fall in the end, who knows? And obviously, the price over the last month has been definitely disconnected from fundamentals of the company in general. But as I kind of said in my last video, I don't want to get into it too much here, but there was a really good technical reason, for the price to, or for people to be buying in, not based on fundamentals of the company, but a technical problem with the company based on the short interest in the company, and that'll kind of fizzle itself out. Either it already has, or it will, organically work out over the next few months. So that's that. Oh, and the one other thing I wanted to just show you here in the financials, which I look at too, right, is this also helped me want to keep the company and not sell, even when things kind of looked really nasty. So if we look at the the earnings here per share, where is it? Income statement maybe. So if we look at the income statement and we look at February, right, for 19, and you'll see that you have operating income negative $500 million. And then February 2020, operating income negative $400 million. Now, those numbers look terrible, right? I mean, you can see they almost were negative, almost never negative since 2011. And then you have these massive losses in February of, a full year for 2019 and 2020. But it's really kind of a paper loss, and I want to show that to you, and the goodwill. So if we look here, right, for 2019, you had 8 billion in revenue, right? Here's your cost of revenue. So you had a profit of $2.3 billion. Now, your basic costs, your administrative costs, right, your overhead costs are almost 2 billion. So you have $300 million in profit, right? Then you have $1 billion in this other expenses. Now, if you look at this 1 billion, where is this coming from? What is this? And that's kind of what gives you the negative here, when it all washes out of negative 700 million. So most of this is a write-off of its goodwill. So if we go down to goodwill impairment, right, and you can see, right, they took an impairment years ago, and then no impairment, no impairment, no impairment. Then they took a $971 million write-off. So if you back that back out, and it does it here too, right? So if you back that out, here's your, earnings before taxes and depreciation, right? Back positive, $400 million, right? Same thing for 2020, right? You can see here they had negative 400 million, but they had this other expense of $415 million. So if we go down and we look, oh, look at this. Here's the goodwill impairment, right? $364 million. So again, you back that out and it's positive again, or very close to it. So that was just another reason why I said I'm not selling this, even though it's at $2 a share and looks like it's going to go bankrupt. The numbers that are in the financial statement, right, the balance sheet, the income statement, they don't show a company that's going bankrupt. They don't show a company that's worth only $3 or $4 a share. That's kind of my thesis, or my opinion on why it was undervalued, and it eventually would come out and be recognized for its fair market value, whatever that number may be. And I don't like to put targets on things because things change daily, right? We don't know what the future holds, and we can only base on what we know today. But tomorrow the numbers could change up or down significantly based on something like a pandemic happening or a pandemic ending. But yeah, those are my my reasons for purchasing back in 2018 and for holding today. And I think that just gives you a very brief overview of kind of how I go through and analyze a stock. And I'll do this for some of the other stocks that I own that are actually part of the M1 Finance portfolio. But because GameStop is so hot in the market right now, I felt like it was a good one to jump on and to do an intro video on why I would I would purchase a stock such as GameStop. With that said, I'll wrap this up. I appreciate you staying to the end, watching the video. Please like and subscribe. Any questions, any comments, anything you didn't understand, need me to go over further, write it in the comments below, or send me a message, and I'll try to answer them for you. Until next time, have a good one.